Welcome students to another lecture in this series. Greetings of the day. Let us continue with the practice of ratio analysis. We have covered all the categories of ratios. Before doing numericals, I would like to cover the last theoretical topic from this topic of ratio analysis. First of all, we do have here advantages of ratio analysis to discuss. We have seen that it is a very important resource, or you can say tool, to perform comparative analysis, or you can say financial analysis. It is a tool of financial analysis. Okay, so let us see. You know that financial health of a business is very important for its success, and this acts as a tool to diagnose that financial health. Okay, so first of all, it is useful in analysis of your financial statements. The very first point, it is useful in analyzing the financial statements, that is your P&L account and balance sheet. And such analysis is made not only by the management, but it is also made by the outsiders like your bankers, creditors, investors, because they are interested in knowing the exact financial position of your organization so that they can take their further decisions. Then we have useful in improving the future performance. Ratio analysis indicates the weak spots, the weak points of the business. This helps the management in overcoming the weaknesses and improving the overall performance of your business, because it can find out that where you are lacking by performing these comparisons through ratios. Ratio analysis helps us to perform inter-firm comparisons also, like this, that comparison of absolute data as compared to that, it's easy to compare, or it's more fruitful to compare the ratios, because when the comparison is made on absolute data, it is better to compare the ratios. Suppose if a firm is having a net profit of 50,000, while the other firm is having a net profit of 1 lakh. So it does not necessarily mean that firm B is better off unless this profit figure is converted into a ratio and it is compared. So these absolute figures are not that important unless and until they are being converted into ratios, percentages, and then a comparison is being performed. Then it is useful in judging the efficiency of a business. We have discussed this before also, that your accounting ratios help in the efficiency of a business. They basically see the three important aspects, that is your liquidity, solvency, and profitability of a business, because it can be easily evaluated and calculated with the help of various accounting ratios. We have seen many. So such kind of evaluation helps the management to judge the operational efficiency of the various aspects of your business. Then the last advantage that I have mentioned here is that it is useful in simplifying the accounting figures. You know that accounting data can be complex, that is presented in the form of a P&L account and balance sheet, and these ratios can easily simplify them, summarize them, and systemize them, so that you can easily understand them. Like if I give you example, gross profit ratio, net profit ratio, they give more easily understandable picture about the profitability of a business as compared to just the absolute profit figures. So it is more useful. So these were the basic advantages of ratio analysis. Next part, let us see the limitations. Ratio analysis, is a very useful technique we have just discussed, but one should be aware of its limitations as well, because these limitations should be kept in mind while making use of ratio analysis in interpreting your financial statements, because if you are aware of these limitations, then you can safeguard yourself from misleading. So first we have here is the reliability of ratios depends upon the correctness of the basic data. You know that ratios, the data for ratios is being picked from your financial accounts, from your final accounts, basically your balance sheet and P&L account. So if the data from them is unreliable, so obviously it will be a mistake to put any reliance on the ratios worked out from those financial accounts, right? So the base needs to be strong, the source of data needs to be strong. Sometimes it happens that an individual ratio may by itself be meaningless. This is quite possible. So except in a few cases, an accounting ratio may by itself be meaningless, and it acquires significance only and only when it is compared with the other relevant ratios of the other firms or of the previous years. So in fact, ratios actually yield their best advantage on the comparison only, right? So if the ratios for a year are compared with the ratios in the previous year, it will be a useful exercise. So comparison is the essential requirement of your using ratios for interpreting any situation, any firm, any organization. An individual ratio may not infer you much information about the current situation. Then we have that ratios sometimes, like, it's not always possible that it is comparable. Some when suppose the ratios of two firms are being compared, so it should be kept in mind that the different firms may follow different accounting practices. That would have a misleading result, right? Like if I take example, if one firm is using depreciation on straight line method and the other firm is using depreciation on diminishing value, so in that case the comparison won't be possible. Same ways, if they both are adopting different methods for stock valuation, again the comparison would be meaningless. So such differences will make some of the accounting ratios strictly comparable. They actually will not allow you to compare them. So however, use of accounting standards makes them comparable, because the accounting standard which says that you should use the consistency principle, the same methods over the years, over the firms in the same industry, so that actually helps you to perform it. The next disadvantage we have here is that ratios sometimes give a misleading picture. Let me give you an example that how ratios can be misleading. Suppose a company produces 500 units in 1 year, okay, and in the next year it produces 1000 units. Almost there is a 100% progress, okay. Now next firm, suppose it used to produce 4000 units in 1 year, and next year it is producing 5000 units, means a plus of 1000 units. But if you calculate the percentage, it is showing 25% only, that there is a 25% progress in the production level, though it is producing equal number of units. Like there you saw that total 1000 units were produced in the whole year in the first example, whereas in the next example we have seen that there is an increase of 1000 units and total 5000 units are being produced. So in that case, the second firm will appear to be less active than the first firm, though it is just the rate of increase that is being compared. So it will be much more useful if the absolute figures are also taken into consideration along with the rate of increase, unless the firm being compared are equal in all respects. Means a small firm cannot be compared with a big firm. So one should be extremely careful while comparing the results of one firm with those of the other firms. Then we have that ratios ignore the qualitative factors. They are a matter of fact, they are the tools of quantitative analysis, and it ignores the qualitative factors, which sometimes are actually very important for the progress of the organization. So as a result of this, conclusions from ratio analysis may be distorted. Okay. Then next we have changes in price levels makes ratio analysis ineffective. Changes in price levels actually effect for a number of years. Like it makes comparison of figures for a number of years difficult, because over the period of time the prices might have got changed. Like if I take an example for this, the ratio of sales to fixed assets in 2010 would be much higher than in 2004. Why? Because the rising prices, because fixed assets are still being expressed on the same on the basis of cost incurred a number of years ago, while the sales are being expressed at their current prices. If I'm calculating sales to fixed assets ratio, then fixed assets remain the same at their old value in 2004, but the sales is actually being valued in the current prices. So sometimes it can be possible. The next disadvantage we have, that there is no single standard for comparison, because ratios of a company have meaning only when they are compared with some standard ratios. So circumstances may differ from one firm to another firm, and nature of the industry may also be different. So therefore the standards will differ for each industry, and the circumstances of each firm will have to be kept in mind while comparing. So it is difficult to find out a proper basis for comparison. Therefore the performance of one industry may not be properly comparable with that of another. So usually it is recommended that the ratios should be compared with the average of industry. But industry averages are not easily available. That is also an important factor to consider. Then ratios based on past financial statements are no indicators of future. Why? Because the accounting ratios are calculated on the basis of financial statements of the past years, and the amounts are like of the past. So ratios thus indicate that what happened in the past basically. Since past is quite different from what is likely to happen in future, it is difficult to use ratios for forecasting purposes. The financial analyst is more interested in uh, getting to know that what will happen in future. They would like to analyze the future. So the management of a company has information about the company's futures, plans, policies, and is therefore able to predict future to a certain extent. But an outsider analyst has to rely upon the past ratios, which may not be necessarily reflecting the firm's future financial positions and performance. So here we can say that ratios are quite useful, but still they do have certain disadvantages that we have studied. Now let us move towards practice of your questions based on ratios. Here we have a question. Let us begin with it. They have given you the net working capital of 2.8 lakhs as on 30th June 2010, and the following financial ratios and performance figures are given to us, where we are having current ratio, liquidity ratio, inventory turnover on cost of sales, gross profit on sales, credit allowed in months. And they are saying that the company fixed assets is equal to 90% of its net worth, share capital plus reserves, while reserves amount to 40% of share capital. So this is actually an important question. You need to prepare a balance sheet here. Generally what happens that P&L account and balance sheet is given to you, but here in this question they have given you all the information related to your items that are like there in that, and they are asking to prepare the sorry they are asking you to prepare the balance sheet of the organization. So first of all, let us calculate the current assets and current liabilities. We are given with current ratio. Let us see. And they are saying that we do have a net working capital given to us as 2,80,000. Let us see how will we calculate. We will consider current ratio as current assets upon current liabilities. We are having current ratio as 2.4 by, it is given to us in the question. Sorry for that. So from here we are able to obtain the relationship between current assets and current liabilities. We have cross multiplied it and obtain a CA equals to 2.4 CL. We are having net working capital as 2.8 lakhs given to us, so we can use that relationship. In this equation we have substituted a value of CA with this equation. So 2.4 CL minus CL equals to 2,80,000. From here we can calculate the current liabilities, and simply we can multiply 2.4 with current liabilities to obtain the current assets. Stock can also be obtained using these values, current assets minus stock upon the current liabilities. Let us see how to calculate it. We can put up the values and can obtain the amount of the stock. Then let us calculate cost of sales, because in the question we have seen that we are given inventory turnover on cost of sales. So it is given as 8. So we can use the formula inventory turnover ratio equals to cost of sales upon the stock. So from there we can calculate the cost of sales, that is 12,80,000, and further we are given that gross profit on sales is 20%. So if it is on sales 20%, so it will be 25% on cost of sales. So from there you can calculate your gross profit, 25% of your 12,80,000, that is 3,20,000. Now let us calculate sales. Cost of sales is given to us. We can add profit to it and obtain sales as 16 lakh. Now when we have obtained sales from this formula of average collection period, which is actually given to us as 1.5 months, we can calculate debtors. Let us see, credit sales is 16 lakh, we have just calculated. After calculating, you are able to obtain the debtors as 2 lakh from this. Now we can calculate cash using current assets. We can add stock, debtors and cash, all three. We have already calculated current assets and stock and debtors. From there we can obtain the value of cash. Now it is given in the question that your fixed assets is equal to 90% of its net worth, and net worth can be calculated by adding capital and reserve, and also it can be calculated using fixed assets plus the net working capital. And we know very well that fixed assets are equals to zero point 0.9 or 90% of the net worth. So I have replaced this in the equation. In place of fixed assets, I have mentioned 90% of net worth plus the net working capital amount is given to us. From there, net worth is acting as a variable, and from there you can calculate its value as 28 lakh. Further, 90% of net worth is fixed assets, so we are able to obtain the fixed assets as 25 lakhs 20,000. Now let us see the last part. We know that net worth is given as, we have calculated as 28 lakhs, which is equals to capital plus reserve, and it is given in the question that reserves are equal to 40% of capital. So from there we can form the equation that capital plus, in place of reserves we can put zero point 0.4 capital and calculate the value of capital from there, and reserves both, and lastly we can put all the values in the balance sheet and total it out. You will be able to match the balance sheet. We have more questions to practice. We will be practicing it in the class as also. So here I can show you all the results. We will continue with this in the next lecture. Thank you.